Hello everyone. Welcome to the course of International Macroeconomics. Now we will discuss Chapter 4, Exchange Rates 2, the Asset Approach in the Short Run. As we saw in the last chapter, the monetary approach to exchange rates may work in the long run, but substantial deviations from purchasing power parity, we call PPP, occur in the short run. The same basket of goods generally does not cost the same everywhere at all times. These short-run failures of the monetary approach promoted economists to develop an alternative theory to explain exchange rates in the short run, the asset approach to exchange rates. The asset approach is based on the idea that currencies are assets. The price of the asset in this case is the spot exchange rate, the price of one unit of foreign currency. So far, we have assumed that exchange rates are determined by market forces in the goods, money, the forex markets. So our theory is relevant when the exchange rate flows, and the authorities leave it to find its own market-determined level. At first, we discuss exchange rates and interest rates in the short run, UIP and forex market equilibrium. To begin our study of the exchange rates in the short run, we considered US investors with two alternatives investment strategies: a one-year investment in a US dollar account with an interest rate I US dollars, or a one-year investment in a euro account with an interest rate I euros. We assume home is the United States and the foreign is Eurozone, and require that the dollar rate of return on the home investment equals the expected dollar rate of return on the foreign investment, where each interest rate is an annual rate. Exchange rate of dollars per euro is today's exchange rate, and expected exchange rate dollars per euro is the expected future exchange rate that will prevail 1 year ahead. So, interest rate on dollar deposits is equal to interest rate on euro deposits plus expected rate of depreciation of the dollar. Also, it means that dollar rate of return on dollar deposits should be equal to expected dollar rate of return on euro deposits. The uncovered interest parity, we call UIP equation, is the fundamental equation of the asset approach to exchange rates. As we have seen, by rearrange this equation, if we know all of the other variables, we can solve it for the spot exchange rate. In Figure 4.1, the nominal interest rate and expected future exchange rate are treated as non-exogenous variables in green. The model uses these variables to predict the unknown endogenous variables in red, the current spot exchange rate. To get familiar with the concepts we have just studied, let's work through numerical examples to show how equilibrium in the forex market is determined. Suppose that the current European interest rate I euros is 3% and the current US interest rate I euros is 5%. Suppose also that we have made a forecast that the expected future exchange rate in 1 year's time is $1.224 per euro. Now examine table 4.1 to see how, for various values of the spot exchange rate E, we can calculate the domestic rate of return and expected foreign rate of return in US dollars. Remember, foreign returns have two components. One due to the European interest rate I euros, and the other due to the expected rate of depreciation of the dollar. As shown in table, the dollar interest rate is 5% in current 1. The euro interest rate is 3% in current 2. And the expected future exchange rate 1 year ahead is E exchange rate of expected is equal to $1.224 per euro in current form. The lows in the table correspondent to a range of possible spot exchange rates shown in current 3, and these spot rates in turn imply that the expected depreciation rates in current 5 and the expected foreign returns in current 6. The unique equilibrium is highlighted, where both domestic and expected foreign returns are 5% in annual dollar returns, where both domestic and expected foreign returns are 5% in annual dollar terms, and the spot rate is $1.2 per euro. Figures are rounded in the table. Figure 4.2 plots the domestic and foreign returns columns 1 and 6 against the spot exchange rate column 3. The domestic dollar return we call DR, we call capital DR, is 5%. The euro interest rate is 3%, and the expected future exchange rate is $1.224 per euro. The foreign exchange market is in equilibrium at point 1, where the domestic returns DR and the expected foreign returns FR are equal at 5%, and the spot exchange rate is $1.2 per euro. How is the equilibrium reached? Suppose that initially the market is out of equilibrium, with the spot of exchange rate of dollars per euro, with the spot exchange rate E at a low level, so that the foreign return, the right-hand side of equation, exceeds the domestic return, the left-hand side. At point 2 in figure 4.2, foreign returns are above domestic returns, with the spot exchange rate of $1.16 per euro and an expected future exchange rate as high as $1.224 per euro. The euro is expected to appreciate. The euro is expected to appreciate by 5.5%. Is equal to 1.224 over 1.16 minus 1. In addition, euros earn at an interest rate of 3% for foreign expected return of 5.5% plus 3% is equal to 8.5% is equal to 0.085, which far exceeds the domestic returns of 5%. At point 2, in other words, the Europe offers a high return. Traders want to sell dollars and buy euros. This market pressures bid up the prices of a euro. The dollar starts to depreciate against the euro, causing the exchange rate to rise, which moves foreign and domestic return into equality and focus on the exchange rate back toward equilibrium at point 1. The same idea applies to a situation in which the spot exchange rate E is initially too high. At point 3, the figure 4.2, if euro deposits pay 3%, the domestic return of 5% at point 3, the Europe offers a low return. Traders will want to sell euros. At point 1, the Europe is neither too cheap nor too expensive. Its price is just right for uncovered interest party to hold, for arbitrage to cease, and for the forex market to be in equilibrium. To gain greater familiarity with the model, let's see how the forex market example shown in figure 4.2 responds to 3 separate shocks. A higher domestic interest rate I dollars is equal to 7%. A lower foreign interest rate I euros is equal to 1%. A lower expected future exchange rate is equal to $1.2 per euro. These 3 cases are shown in figure 4.3, panel A, B, and C. In all these 3 cases, the shorts make dollar deposits more attractive than euro deposits, but for different reasons. Regardless of the reasons, however, the shorts we examine all lead to dollar appreciation. A change in the domestic interest rate. In figure 4.3, panel A, a rise in the dollar interest rate from 5% to 7% increased domestic returns, shifting the DR curve up from DR1 to DR2. At the initial equilibrium exchange rate of 1.2 euros, $1.2 per euro on DR2, domestic returns are above foreign returns at point 4. Let's look at a change in the foreign interest rate. In figure 4.3, panel B, a fall in the euro interest rate from 3% to 1% lowers foreign expected dollar returns. A fall in the euro interest rate from 3% to 1% lowers foreign expected dollar returns, shifting the FR curve down from FR1 to FR2. At the initial equilibrium exchange rate of $1.2 per euro on FR2, foreign returns are below domestic returns at point 6. Dollar deposits are more attractive and the dollar appreciates from $1.2 per euro to $1.177 per euro. The new equilibrium is at point 7. Let's look at a change in the expected future exchange rate. In figure 4.3, panel C, a fall in the expected future exchange rate from 1.224 to 1.20 lowers foreign expected dollar returns, shifting the FR curve down from FR1 to FR2. At the initial equilibrium exchange rate of $1.2 per euro on FR2, foreign returns are below domestic returns at point 6. dollar deposits are more attractive, and the dollar appreciates from $1.2 per euro to $1.177 per euro. The new equilibrium is at 0.7. Then we will discuss 4.2 interest rates in the short run, money market equilibrium. In the last chapter, we developed a theory of the long-run exchange rate, the monitoring approach, which can be used to forecast the future exchange rate. That leaves us with just one unanswered question. How are current interest rates determined? Let's look at 4.2.1, money market equilibrium in the short run. How nominal interest rates are determined. Let's look at the assumption. In this chapter, we make short-run assumption. The price level is sticky. It is no predetermined variable, fixed at P is equal to P bar. The bar indicates a fixed value. The nominal interest rate I is fully flexible and adjusted to bring the money market to equilibrium. The assumptions of sticky prices, also called nominal rigidity, is common to the study of macroeconomics in the short run. Let's look at the model. The expression for money market equilibrium in the two countries as follows. U.S. supply of real money balance is equal to U.S. demand for real money balances. European supply of real money balances is equal to European demand for real money balances. Figure 4.4 represents the U.S. money market. The supply and demand for real money balances determine the nominal interest rate. The money supply curve, MS, is vertical at M1 US over P bar 1 US because the quantity of money supplied does not depend on the interest rate. The money demand curve, MD, is downward sloping because an increase in the interest rate raises the cost of the holding money, thus lowering the quantity demand. The money market is in equilibrium when the nominal interest rate I1 dollars is such that real money demand equals real money supply at point 1. At point 2 and 3, demand does not equal supply, and the interest rate will adjust until the money market returns to the equilibrium. If interest rates are flexible in the short run, there is nothing to prevent them from adjusting to clear the money market. But how do market forces ensure that a nominal interest rate I1 subdollars is attained? The adjustment process works as follows. Suppose instead that the interest rate was I2 at point 2. At this interest rate, real money demand is less than real money supply. The public wants to reduce its cash by exchange for interest-bearing assets such as bonds, saving accounts, and so on. That is, they will save more and seek to lend their money to borrowers. So the interest rate will be driven down. In figure 4.4, we move from point 2 back toward equilibrium at point 1. A similar story can be told if at point 3, where there is an excess demand for money. In this case, the public wishes to reduce their savings in the form of interest-bearing assets and turn them into cash. So the interest rate will be driven up. These adjustments ends early when point 1 is reached and there is no excess supply of real money balances. For point 2.4, another building block, short-run money market equilibrium. This model of the money market may be familiar from previous courses in macroeconomics. The lessons that are important for our theory of exchange rate are summed up in Figure 4.5. In these models, the money supply and real income are known exogenous variables in green boxes. The models use these variables to predict the unknown endogenous variables, the nominal interest rates in each country. Money market equilibrium depends on money supply and money demand. If either changes, the equilibrium will change. To help us better understand how exchange rates are determined, we need to understand how these changes occur. In Figure 4.6, in Part A, with a fixed price level, P1 bar US sub US, an increase in nominal money supply from M1 to M2 causes an increase in real money supply from M1 over P bar to M2 over P bar US. The nominal interest rate falls from I1 dollars to I2 dollars to restore equilibrium at point 2. To sum up, in the short run, all else equal, an increase in a country's money supply will lower the country's nominal interest rate. A decrease in a country's money supply will raise the country's nominal interest rate. In Figure 4.6, in Panel B, in Figure 4.6, in Panel B, with a fixed price level, P1 sub US bar, an increase in real money, an increase in real income from Y1 to Y2 US, cause real money demand to increase from MD1 to MD2. To restore equilibrium at point 2, the interest rate raised from I1 to I2. To sum up, in the short run, all else equal, an increase in a country's real income will raise the country's nominal interest rate. A decrease in a country's real income will lower the country's nominal interest rate. 4.2.7, the monetary model, the short run versus the long run. Consider the following example. The home central bank that previously kept the money supply constant suddenly switches to an expansionary policy. In the following year, it allows the money supply to grow at a rate of 5%. If such expansions are expected to be a permanent policy in the long run, the predictions of the long-run monetary approach and facial effect are clear. The home interest rate rises in the long run. If this expansion is expected to be temporary, then all else equal, the immediate effect is an excess supply of real money balances. The home interest rate will then fall in the short run.